Is it possible to outperform the S&P 500 index without doing anything? That's a question I've been trying to answer over the last few years. If you're interested in how I got started in this experiment, it was actually a bit by accident. You can check out this video here and then come back. Today, I'm going to do an update of how the performance was in the coffee can portfolios for the first quarter of 2023. We'll also take a look at how the portfolios have performed since inception. I'll also show you which of the stocks in each portfolio has performed the best, which has performed the worst, and which ones are most responsible for its total performance.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In April of 2020, which was the same date as the NFL draft for that year, I started this portfolio and basically I just chose 32 different stocks, kind of like an NFL draft, and I put $1,000 in this portfolio. As of today, the total return, all dividends reinvested, value of that account is $16.33, which is a total return of 52.3%. Of that 52.3%, the majority of it was market gain and a little bit of it was in dividends. Anytime you're looking at the total return performance of your portfolio or someone else's, it's always important to understand the context of how the overall market did over that time period. So that's why we need to take a look at how the S&P 500 index performed. So here I have on Yahoo Finance the S&P 500 Total Return Index. And you can see for the dates I have April 23rd, 2020, which was the exact same day I started the other portfolio, through April 8th, which is the, actually that's tomorrow. I'm recording this on April 7th, so that's kind of weird. But anyways, you can see the total return is 51.75%. So the first coffee can portfolio returned a little bit over 53%. So we're outperforming in this case by about 2% over the span of 3 years, which may not sound like a particularly great result, but keep in mind that over a long period of time, 90% of actively managed mutual funds fail to even keep up with the S&P 500. So this is overall a pretty good result, particularly since I literally have not done a single thing since I bought this portfolio. So what stocks did I buy? Well, the idea of the original portfolio was simply to buy some high quality dividend stocks. So it wasn't anything particularly outstanding, but we'll take a look at the holdings of that original portfolio. So now we're back over at M1 Finance, and I'm going to sort these by top to bottom gain. And what I'd like to draw your attention to here is the number of stocks that outperformed the S&P 500. So the S&P returned about 51%. So everything above this line outperformed and everything below this line underperformed. And if you count the top, so there's 15 stocks that outperformed the market and 17 stocks that underperformed the market. So how is it possible that this particular portfolio outperformed the S&P 500, even though the average stock did not? Well, the key is the mathematical rationale behind the coffee can, which is that the portfolio winners become a bigger and bigger part of the portfolio, and the portfolio losers become a smaller and smaller part. Remember that if you have a stock and you invest $100 in it, the most you can lose is $100, but the most you can make is basically infinite. So the coffee can portfolio basically takes advantage of that math. So you can see that the best performing stock, which was McKesson, is up over 173% over that time period. So on an initial investment of $29, this stock has nearly tripled in value, now worth almost $80. So even if one of my initial investments for $29 were to go to zero, McKesson's gain alone would make up for that and then some. There are two other stocks with gains over 100%, and then several others that are close. So here we have the bottom of the list. Remember, these were all the stocks that underperformed the S&P 500. The worst performer is down 4.3%. That is Ecolab. And we also have one other, Jack Henry, which is in the red. And you'll notice that the weightings for these is now lower, much lower than the top of the list. So this represents the initial investment. This represents the current weighting. So actually, I overweighted Ecolab, just kind of bad luck. Overweighted the worst performing stock, but it is now worth 3.3% of the portfolio. Jack Henry is worth 2.3. And so if these positions continue to lose, and the others continue to win, the overall percentage of these positions will shrink closer and closer to zero. So in a sense, this coffee can methodology kind of sells the losers on its own, right? It's like you don't actually sell them, but they sort of sell themselves and become less and less relevant over time. So this was actually the original coffee can portfolio. I started another coffee can portfolio, which I did not intend to start at the time, sort of by accident, but it was an effort to determine which valuation ratio would perform the best. My theory was that shareholder yield would outperform dividend yield and several others. And so my point for making this video was really to show that I think shareholder yield is the more effective valuation ratio and is way underappreciated, while dividend yield tends to be highly overrated. So what I did was I took the top 30 by dividend yield, top 30 by shareholder yield, and top 30 by 3 other valuation ratios, and I basically sector neutralized them relative to the S&P 500. So for example, there was, I think at the time, about 24% in the S&P 500. So I bought 8 different technology stocks at a 3% weighting each, which equaled about 24%. So all 5 portfolios had the same sector weighting, and the point for this was to demonstrate the power of the ratio itself, not just get lucky because you happen to overweight a sector that went on to do really well. So I was trying to isolate just the performance of those valuation metrics by themselves. The thing was, I meant to rebalance these portfolios, and I sort of forgot. I just didn't do anything to them, and I checked, I think a couple years later, year or so later, and I was like, wow, these portfolios have done really well. I haven't done a single thing to them. I wonder if there's something to this. Maybe just doing nothing is actually doing something for my total return, and that sort of kicked off my interest in this coffee can type methodology. So here's the valuation ratio derby over at M1 Finance, and you can see that there are the 5 portfolios that I made, and I'm sorting them now by the gain top to bottom. So you can see, as I theorized, the best performer is the high shareholder yield portfolio. That's up 85%. The high dividend yield portfolio is up 71%. And then the other portfolios are up between 40 and 45%. But remember, we're not going to be impressed with this because we don't know how the S&P 500 did over this time period. So you can see that I started this portfolio on May 4th, 2020, which was obviously a very good time to put money into the market. I invested $1,000 in each portfolio, so $5,000 total. So let's see how the S&P 500 has done since May the 4th. Side note, May the 4th. So here we go back to Yahoo Finance, and we're going to change this to May the 4th through today, and we'll hit apply. So the S&P 500 has generated very similar returns over this time period, up 52.04%. So as we see, all these 5 portfolios combined are up 56.4% compared with 52%. Again, up 4%, basically 4.5% relative returns in a 2 years time period, which again, if 90% of people fail to beat the market, that is a pretty decent result. But the real big deal that I've made out of this is not only that the high shareholder yield did well, which is what I theorized, but just how well it did. This portfolio is up almost 85%, and that compares with just 52% for the S&P 500. And if we dig into this particular portfolio, this high shareholder yield portfolio, you again see a very similar picture. In fact, the number 1 performing stock is up 366% in less than 3 years. So this one position has basically made up for the gain alone made up for 3 entire positions that could have gone bankrupt, and you still would have made a positive return. And then we have a long list of positions that are up over 100%, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 positions that have doubled over that time period. And the bottom of the list is slightly deceptive. You'll notice I have a position in the Vanguard Total Stock Market Index. I actually sold some losers out of this portfolio to harvest losses, and I reinvested that money back into the Total Stock Market Index. So I guess I did technically take action here. Just sold the stock losers to take the loss. So in this case, if I did the same, I could actually harvest a loss in the total stock market. SLG, I could also sell this and take a capital loss. But you can see that some of the worst performers, obviously SLG is down over 24%. And there are several positions that have underperformed the market pretty badly. Those are all here: NRG, eBay, Comcast, DaVita, and Xerox. Just know that there's a few others that aren't contained in this list because I sold them and took the loss. And I think there were about 2 positions that I did with, maybe 3. And that brings up another interesting component of the coffee can, which is that let's say you just bought, however many stocks to start with, and then every single year you just sold only the stocks that were at a loss and kept everything else. Technically, you would have a tax negative portfolio, meaning the IRS would literally pay you to own the portfolio because you can actually write off up to $3,000 in capital losses, at least in the US. And this is not tax advice, talk to an accountant. But you can write off up to $3,000 in losses each year off your taxes. So assuming you're in, say, a 25% tax bracket, you would get 25% of $3,000 or $750 back on your taxes just for selling these losing positions. Meanwhile, all the winning positions, you would defer the taxes on those until you eventually took money out of the portfolio. So in a sense, it becomes a little bit like an IRA, not quite, but a little bit like an IRA in that you're extremely tax efficient, in some cases even tax positive, for owning a portfolio like this. So the coffee can concept combined with the high shareholder yield concept got me really interested. And I said, what if I just did that alone? And I would buy, I started off saying I'll buy monthly, $1,000 each month in a coffee can portfolio. That was going to be a problem with M1 Finance. So I decided I'll just do $3,000 every quarter, which I'll update. If you're on Patreon or the YouTube Premium, I'll publish all of my purchases after I make them. But I'll also share the results just with everyone on YouTube. If you're interested in following along on Patreon, appreciate your support. So let's check out how the official coffee can portfolios have done since inception. So here we are back in M1 Finance, and I've got a starting value of, the starting date of August 1st, 2022. So far, I've invested $5,000 in the portfolio, and as you can see, the market hasn't done that well over this time period, but portfolio is up a little bit, total return of 6.5%. That is with dividends reinvested, and you can see the breakout of market gain versus dividends over this time period. But remember, I'm not going to be impressed. We got to check and see how the S&P 500 has performed before we can assess the abilities of this portfolio. You can see the breakdown of each portfolio down below. This is a little skewed because I did start these at different time periods, but most importantly, we're looking at overall return at 6.5. And if we switch over here to the S&P 500 and start at August 1st, 2022 in the S&P 500 Total Return Index, actually surprising how well the portfolios have done. The S&P 500 is up 0.6%. Which is surprising to me how well the coffee can has done, simply because, so far this year, it's really been a major reversion back to the technology stocks, of which I have very few in this particular portfolio. So far, really good. The portfolio is up 6.5% compared to about less than 1% for the S&P 500. So if we can keep up this annualized pace of outperformance, this portfolio would be in the official legends category. I don't think it's going to maintain this pace. They're going to have some bad times, some good times. But so far, so good. Let's real quick check out year to date. So year to date, definitely not as impressive so far this year. The portfolio is up 3.94%. And if we check over here, the S&P 500 year to date is up 7.4%. So 7.4 for the S&P 500 and only 4% for this portfolio. So we're underperforming so far to start the year, but since the inception of all of these portfolios, we are outperforming by a pretty good margin. So for all three of the portfolios that I've started and have not touched, all three of them have outperformed the S&P 500 over their respective time periods. Obviously, a couple of them are pretty close. And then if you look at the valuation ratios, there were a couple that underperformed. So I don't think the coffee can is a guaranteed way to outperform, but I do think it is a very effective way to sort of trick yourself psychologically into buying and then holding your investments over a long period of time. By simply doing that, you're not interrupting the compounded effect of the investments that you bought originally. If you are constantly buying and selling your stocks, you're not giving the businesses enough time to compound themselves. Plus, the coffee can portfolio allows the simple laws of mathematics to work in your favor. As you saw with several of the positions that were in one of the portfolios, they had, gone up 1x, 2x. Quanta was almost 4x from what was originally paid for it. So you just need a handful of winners to really have incredible results. And if you pick a bunch of losers, that's okay. They can all go to zero. As long as you have a handful that do exceptionally well, they can make up for it. Speaking of Coffee Can, if you're interested in supporting me on Patreon or YouTube Premium, like I said, I do publish the purchases in the Coffee Can whenever that's available. I also have a monthly Q&A video that's coming out soon. So if you are a subscriber and you want to get a question in for that, you still have a couple days to do that. I'm a little bit late just from house projects we've had going on, but I am going to record that hopefully early next week. So that'll be coming out. And then also a fun announcement, I now have merchandise available for purchase. This is mostly just for fun. I mean, I make a couple pennies on it maybe, but basically these are just some fun things to have, investing shirts or mugs or stickers or whatever you want. So I actually have one for the coffee can portfolio. I'll put a picture on the screen. There's also a couple others available. So if you're interested in that, check it out. You can look at the link in the description down below if you want to purchase that. I purchased several things that I'm excited to get and wear, this sort of fun conversation starters. And if you have any ideas, any fun or funny sayings, let me know in the comment section down below, and maybe we'll turn it into a t-shirt. Like I said, not trying to make money on this necessarily, just trying to have some fun. So buy it if you want, don't buy it if you want, whatever, totally up to you. But hopefully you'll have some fun with this. So as always, thank you for watching, and I will see you in the next video.